In 1920, Charles Ponzi, a charismatic and flashy immigrant, promised the city of Boston the moon, a 50% return in 45 days. He was an outsider, a con man, and his scam burned bright and fast, collapsing in under a year. It was a story of spectacle. But the greatest liars aren't loud. They are quiet. They don't promise the moon. They just promise a steady, reliable piece of the sky. For over 3 decades, one man sat at the absolute center of Wall Street. He wasn't a flashy outsider. He was the ultimate insider. He was the former chairman of the NASDAQ. He was a pioneer in electronic trading. He was a trusted advisor, a philanthropist, a quiet pillar of the financial community. His name was Bernie Madoff, and for all those years, he was running a Ponzi scheme. Not a chaotic million-dollar scam like the one that defined the 1920s, but a cold, precise, multi-decade fraud that would vaporize $65 billion in the largest financial crime in human history. This isn't just a sequel to the Ponzi story. This is the story of its final, terrifying evolution. To understand the Madoff scandal, you have to understand the man. Bernie Madoff was not a high roller. He was the opposite. In a world of volatile traders and slick salesmen, he was boring. And in the world of high-stakes investing, boring means safe. He founded his firm, Bernard L. Madoff Investment Securities, in 1960 with a few $1,000s. He built it into one of the largest and most respected market makers on Wall Street, a legitimate firm that processed billions of dollars in real trades. This legitimate business was the perfect cover. It gave him an aura of unimpeachable credibility. But on the side, on the secretive 17th floor of his New York office, he ran his investment advisory business. This was the real scam, and his sales pitch was genius in its simplicity. He didn't promise 50% in 45 days. He promised 10 to 12% a year, every year, no matter what. When the market crashed, his fund went up. When the market boomed, his fund also went up, just a little. He delivered what every rich person on earth craves: steady, predictable, low-risk returns. His fund became known among the elite as the Jewish T-bill, the safest investment in the world. His second trick was exclusivity. You couldn't just buy into Madoff's fund. You had to be invited. He made people beg to give him their money. He would turn people away, saying the fund was closed. This made access the ultimate status symbol. It wasn't just an investment, it was an exclusive club. He cultivated this image at elite country clubs in Palm Beach and Long Island. He didn't sell his fund. He let his existing ecstatic clients do the selling for him. They would whisper to their friends, "I'm with Bernie. I get 12% every year. Maybe I can get you in." It was a social virus, and it spread through the wealthiest, most sophisticated communities in the world. When pressed, Madoff told his investors he was using a complex strategy called a split-strike conversion. He claimed he was buying a basket of large-cap stocks, then hedging them with options contracts. It sounded brilliant. It was technical, sophisticated, and just boring enough that no one wanted to question it. But the brutal reality was far simpler. It was also far more insane. There was no split-strike conversion. There were no trades. For decades, when investors gave Madoff their money, he did nothing with it. He simply deposited it into a checking account at Chase Bank. When an investor wanted to redeem their profits, he just paid them out of that same account, using fresh cash from new investors. It was Charles Ponzi's 1920s blueprint, scaled up to an industrial digital level. The entire investment side of his business was a theatrical production. The 17th floor of his office was a front, staffed by a small, loyal crew who did no real work. The trades were pure fiction. The account statements that his clients received, the statements that showed those perfect, steady returns every single month, were fakes. They were generated by a single loyal employee, Frank DePascali, using an ancient 1990s-era IBM computer and a dot matrix printer, often by looking up historical stock data and backdating the trades. The entire $65 billion empire, the engine of so much wealth and trust, was a complete fabrication. It was a paper kingdom built on a single, massive checking account and an old printer, and the system fed itself. Other large financial institutions, known as feeder funds, sprang up. Their entire business was to gather money from smaller investors and feed it to Madoff, taking a hefty commission for the access. These funds, run by sophisticated managers in places like Switzerland and London, either never did their own due diligence, or they suspected the fraud and kept feeding the machine anyway, because the commissions were too good to pass up. A scam this big, running for this long, cannot exist in a vacuum. It requires one more crucial ingredient: systemic failure. The enablers. The primary enabler was the SEC, the Securities and Exchange Commission, the one agency whose entire job was to be the watchdog for Wall Street. And they failed, repeatedly, for decades. It wasn't that no one noticed. One man in particular was shouting about it. His name was Harry Markopolos. A financial analyst from Boston, Markopolos was asked by his boss in 1999 to figure out how Madoff was getting his incredible returns. Within 5 minutes of looking at the numbers, Markopolos knew it was impossible. Those perfectly smooth returns didn't exist in the real world. Within a few hours, he had mathematically proven to a certainty that Madoff was running a Ponzi scheme. He sent his findings to the SEC. His report was titled, "The World's Largest Hedge Fund is a Fraud." The SEC did nothing. They ignored him. Markopolos, obsessed, sent more detailed reports in 2001, 2005, and 2007. He met with SEC staff. He gave them the entire blueprint of the fraud, showing them how to catch Madoff in the act. The SEC's response was, at best, a catastrophic failure of incompetence. They conducted superficial investigations. They looked at Madoff's fake documents, and when Madoff told them his trades were proprietary, they simply left. They never bothered to check with the other side of the trades, a simple step that would have exposed the entire fraud instantly. Why? Perhaps because Madoff wasn't just some small-time hustler. He was Wall Street royalty. He was one of them. He sat on their advisory boards. He was a source. And the regulators, terrified of questioning a king, chose to look the other way. For decades, the one man who tried to stop the bomb was dismissed as a crank, while the bomb itself just kept on ticking. The aftermath was an apocalypse of lost trust and vaporized wealth. The $65 billion number was itself a lie. It was the fake profits Madoff had printed on his clients' statements. The real amount of cash stolen was estimated to be around $18 billion. But for his victims, the number on their statement was their reality, and it was all gone. This is the brutal reality of the Madoff scandal. His victims weren't just billionaires, though there were many. His scheme destroyed the life's work of countless people. The list is horrifying. Elie Wiesel, the Nobel laureate and Holocaust survivor, saw his entire charitable foundation, worth $15 million, vanish. He said, "We have been betrayed." Universities, hospitals, and research foundations across the country were wiped out. But the most tragic victims were the ordinary retirees. The teachers, the small business owners, the families who had put their entire nest egg into feeder funds that promised the safety and reliability of Uncle Bernie. They were left with nothing, forced to sell their homes, go back to work in their 70s and 80s, or depend on family to survive. The cost was not just financial. It was measured in human lives. 2 years to the day after his father's confession, Mark Madoff, Bernie's oldest son, who was never charged with a crime but was hounded by lawsuits and public shame, took his own life. The lie had consumed its own family. Bernie Madoff was sentenced to 150 years in prison, where he died in 2021. But his legacy is a dark shadow that still hangs over us. Charles Ponzi's 1920 scam was a warning about outlandish greed. Madoff's scam is a far more terrifying lesson for our modern world. It teaches us that the most dangerous lies aren't the wild, exciting ones. The most dangerous lies are the quiet, boring, and reliable ones, told by the very people and institutions we are taught to trust the most.